Stocks are sitting on huge gains on expectations of deep rate cuts this year. But my next guests say the Fed may not be as aggressive as investors think. Joining me now, Greg Daco is chief economist at EY, and Jordi Visser is president and chief investment officer at Weiss Multi-Strategy Advisers. Welcome to both of you. Jordi, welcome to the program.
Thanks, Kelly.
I don't want to jump too far ahead here, but I know that you're a big fan of Bitcoin and crypto and some of those asset classes, and this is definitely the day to talk about it. Before that, though, maybe just explain why you don't think the fact that the 10-year went back above 4% today why is that happening at the same time that crypto's taking off, or are these just kind of January 1 positioning quirks?
I think most of what's happening today has to do with a lack of volume coming into the new year and just position shifts. I think people are going to break away from the correlations they've had in the past with crypto and rates. And I think in general, after we've had 2 years of just major surprises in rates, I think people are trying to maybe get a little too over their skis in terms of rate moves being connected back to their assets.
So just to make sure I understand that, I don't know how we've thought about it. I guess we've thought, okay, low rates, negative real rates are a positive for Bitcoin, and the reverse is true. But do you think you see a different relationship forming from here on out?
Yeah, I think this is the year, and I've written about this, that people start to think of Bitcoin differently, partly as just an investment asset that's being embraced by younger people and not so much by people my age. That's changing drastically, and I think we've seen the numbers. So there's a lot of different reasons why all of a sudden now Bitcoin's going to change as an asset, but also there's an innovation component. And I think last year we talked about artificial intelligence as the major innovation theme. Artificial intelligence is directly correlated, in my opinion, to the success of Bitcoin going forward.
So they kind of are going to rise hand in hand.
I think authenticity is going to break down on one side, meaning more fakes, more AI impacting the way that we see things. And the blockchain, which is the technology attached to Bitcoin, is going to continue to grow for a variety of different reasons. Healthcare is one of them. But I think in general this year people will embrace more the way that Bitcoin is being viewed as an innovation. Or
almost like the trustworthiness aspect of it in some ways, shape, or form.
That's exactly
the flip side of that. Greg, let's talk a little bit, we were talking about rates in relation to Bitcoin, but let's talk about where they're going in general. You know, the fact that we've already moved from below 380 to over 4% today, are we undoing the low volume move of last week, or is today, which one's the counter trend?
Well, I think we're all going to be in an environment where the Fed is going to be cutting rates over the course of this year, but perhaps some of the market euphoria is a little bit overdone. We have to remember that the Fed is going to be cutting rates as a function of inflation, and inflation bumpiness is likely to be part of the process as we move through the rest of the year. So yes, we've made a lot of progress. We've had some very encouraging inflationary prints over the course of the last few months, but the bumpiness is likely to put the Fed on a little bit of a hold pattern in the initial part of this year. And I think markets pricing very rapid and aggressive rate cuts early this year may be a little bit over their skis in terms of expectations for what the Fed is actually going to be doing.
You know, I was getting more curious about what could happen with the CPI in the next few months, Greg, because I was looking at the I-bonds again over the weekend and thinking, okay, the floating rate is down to, I think it's a little under 4% now. Do you think, and the early reads for January inflation data look pretty low. So is there a rationale? Is it your expectation that, pick the CPI, if you will, that it backs up a little bit in the months to come?
I think there's a real possibility that we see some upward movement in the coming months in terms of inflation data. Nothing dramatic, maybe a tenth or a couple of tenths, nothing really worrisome. The disinflationary tailwinds are still very much with us. We have an environment in which economic activity is gradually moderating. We have wage growth that is moderating. We have profit margins that are compressing. We have rent disinflation in the pipeline. Right. Let's not forget, the Fed is still maintaining a hawkish and quite aggressive monetary policy stance, has not yet started to cut rates. Yes, we are seeing some of that expected easing in long-term rates, as you were just discussing, but that has yet to materialize. So we're still in a disinflationary environment. It's going to be bumpy on the way down, just like it was bumpy on the way up, and the Fed is going to mechanically react to the easing of inflation and not essentially commit to rate cuts until we are sustainably on that path to 2% inflation.